Question 1. Foundations of captive insurance. Which of the following is the primary reason a company might choose a single parent captive over a group captive? A. To spread risk among multiple unrelated entities for lower individual exposure. B. To achieve customized risk management tailored to the parent company's specific needs. C. To reduce administrative complexities by pooling risks with other organizations. D. To comply with statutory requirements mandating participation in a captive structure. Answer: B. To achieve customized risk management tailored to the parent company's specific needs. Explanation. Option B. Correct. Single-parent captives are designed to meet the specific risk management needs of their parent company, offering tailored solutions not available through traditional or group captives. Option A. Incorrect. Spreading risk among multiple entities is characteristic of group captives, not single-parent captives. Option C. Incorrect. Group captives involve pooling risks, which increases administrative collaboration, not necessarily simplicity. Option D. Incorrect. Participation in captives is usually voluntary and not mandated by statutory requirements. Relevant laws: Rhode Island Captive Insurance Laws, Title 27, Chapter 2743 highlight the flexibility in choosing captive structures based on company needs. Question 2. Legal and regulatory considerations. Scenario-based. Jessica's technology company, based in Rhode Island, is considering forming a captive insurance company to provide cybersecurity liability coverage. She consults a captive insurance expert who advises her on regulatory requirements. Which of the following steps should Jessica take to ensure compliance with Rhode Island's captive insurance laws? 8. File an application with the Rhode Island Department of Business Regulation (DBR) and submit a feasibility study including projected financial statements. B. Obtain approval directly from her company's board of directors without submitting documentation to regulatory authorities. C. Form a protected cell company (PCC) as it does not require initial capital under Rhode Island law. D. Avoid submitting an annual report if the captive has no active policies in its first year of operation. Answer A. File an application with the Rhode Island Department of Business Regulation (DER) and submit a feasibility study including projected financial statements. Explanation. Option A. Correct. Rhode Island law mandates that captive insurers submit an application and a detailed feasibility study to the DBR. This ensures that the captive is financially viable and aligns with statutory requirements. Option B. Incorrect. Regulatory approval is required. Internal board approval alone does not suffice. Option C. Incorrect. PCCS still require capital, and Rhode Island law specifies minimum capital and surplus requirements for all captive types. Option D. Incorrect. All captive insurers, regardless of activity level, are required to file annual reports as part of compliance. Relevant laws. Title 27, Chapter 2743 governs licensing and operational requirements for captives in Rhode Island. Question 3. Reinsurance and captive insurance. Which of the following reinsurance arrangements is most suitable for a captive insurer looking to manage catastrophic losses while retaining a portion of risk? A. Quota share reinsurance. B. Stop loss reinsurance. C. Excessive loss reinsurance. D. Facultative reinsurance. Answer: C. Excessive loss reinsurance. Explanation. Option C. Correct. Excessive loss reinsurance is ideal for managing catastrophic losses. It allows the captive to retain risk up to a specific limit, with the reinsurer covering losses beyond that limit. Option A. Incorrect. Quota share reinsurance involves sharing losses and premiums proportionally, which does not specifically address catastrophic risk management. Option B. Incorrect. Stop loss reinsurance limits the total amount of claims over a period, not individual catastrophic events. Option D. Incorrect. Facultative reinsurance is negotiated on a case-by-case basis, which is less efficient for catastrophic coverage. Relevant concepts. Understanding proportional versus non-proportional reinsurance is critical to managing risk effectively in captive insurance structures. Question 4. Rhode Island Captive Insurance Statutes and Regulations. Which of the following is a specific governance requirement for captive insurers under Rhode Island Captive Insurance Regulations? A. Captive insurers must have at least 2 independent directors on their board. B. A majority of the board must be residents of Rhode Island. C. Captive insurers must appoint a resident director within Rhode Island. D. The board must include a member from the Rhode Island Department of Business Regulation. D. Answer: C. Captive insurers must appoint a resident director within Rhode Island. Explanation. Option C. correct. Rhode Island law requires captives to appoint at least one resident director to ensure local governance and compliance with state laws. Option A, incorrect. While independence may be encouraged, Rhode Island does not mandate a minimum number of independent directors. Option B, incorrect. There is no requirement that a majority of the board must reside in Rhode Island. Option D, incorrect. The DBR oversees compliance but does not require direct board membership. Relevant laws: Rhode Island Captive Insurance Laws, Title 27, Chapter 2743 detail governance requirements, including the need for a resident director. Question 5. Accounting and financial reporting for captive insurers. When preparing statutory financial statements for a captive insurer, which of the following is the primary accounting framework used in Rhode Island? A. International Financial Reporting Standards (IFUS). B. Generally Accepted Accounting Principles (GAAP). C. Statutory Accounting Principles (SAP). D. Cash Basis Accounting. Answer: C. Statutory Accounting Principles (SAP). Explanation: Option C, correct. Rhode Island requires captives to use SAP for regulatory reporting, ensuring a conservative approach to financial management and compliance. Option A, incorrect. IFRS is not the required standard for US base captives. Option B, incorrect. GAAP may be used for internal purposes but is not the primary framework for regulatory reporting. Option D, incorrect. Cash basis accounting does not provide the detailed financial disclosure needed for regulatory compliance. Relevant guidelines: SAP emphasizes solvency and the financial stability of insurance entities. Question 6. Risk management and captive insurance, scenario-based. David, a CFO of a manufacturing firm, identifies that his company faces risks from product liability and supply chain disruptions. He is considering forming a captive insurance company. What is the most appropriate approach for him to assess these risks and determine if a captive is a viable solution? A. Purchase commercial insurance to cover the risks without conducting further analysis. B. Conduct a detailed risk identification process followed by a feasibility study for forming a captive. C. Form a group captive to share risks with other manufacturing companies without performing a feasibility study. D. Secure reinsurance coverage immediately to mitigate potential losses. Answer: B. Conduct a detailed risk identification process followed by a feasibility study for forming a captive. Explanation: Option B, correct. Risk identification and a feasibility study are critical steps in determining if a captive can effectively address specific risks, ensuring alignment with company objectives. Option A, incorrect. Relying solely on commercial insurance without exploring alternatives like captives overlooks cost saving and risk management benefits. Option C, incorrect. Group captives are not always suitable, and skipping a feasibility study risks misalignment with company needs. Option D, incorrect. Reinsurance is a tool for risk management but is not a substitute for a comprehensive assessment process. Relevant concepts: feasibility studies are mandated by Rhode Island regulations for captive formation to ensure a solid risk management foundation. Question 7. Reinsurance and captive insurance. Which type of reinsurance arrangement is best for a captive insurer aiming to reduce its exposure to unusually large individual claims? A. Stop-loss reinsurance. B. Quota share reinsurance. C. Facultative reinsurance. D. Excessive loss reinsurance. Answer: D. Excessive loss reinsurance. Explanation: Option D, correct. Excessive loss reinsurance protects against unusually large individual claims by covering amounts exceeding a specified threshold. Option A, incorrect. Stop-loss reinsurance limits aggregate claims, not individual claim sizes. Option B, incorrect. Quota share reinsurance involves sharing losses proportionally but does not specifically address large claims. Option C, incorrect. Facultative reinsurance is case-specific and may not provide systematic protection for large claims. Relevant laws: effective reinsurance practices are critical for captives to maintain solvency and compliance. Question 8. Taxation of captive insurance companies. Under Rhode Island law, how are premiums collected by a captive insurer subject to state tax obligations? A. Premiums are taxed at a fixed rate of 2% regardless of coverage type. B. Captive insurers are exempt from premium taxes in Rhode Island. C. Premium taxes are calculated based on the type and volume of coverage provided. D. Premiums are taxed only if the captive insurer operates outside Rhode Island. Answer: C. Premium taxes are calculated based on the type and volume of coverage provided. Explanation: Option C, correct. Rhode Island premium taxes are structured based on coverage specifics and ensure fair contribution to state revenue. Option A, incorrect. Premium tax rates are not fixed uniformly at 2%. Option B, incorrect. Captives in Rhode Island are subject to premium taxes unless specific exemptions apply. Option D, incorrect. Captives in Rhode Island are taxed regardless of operation or location. Relevant regulations. Rhode Island premium tax laws ensure captives contribute to state finances based on their activity. Question 9. Emerging trends and challenges in captive insurance. Which of the following represents a significant emerging challenge for captive insurers in the global market? A. Increasing demand for insurtech solutions. B. Evolving environmental, social, and governance-esque requirements. C. Higher availability of traditional insurance options. D. Reduced interest in alternative risk financing mechanisms. Answer: B. Evolving environmental, social, and governance-esque requirements. Explanation: Option B, correct. ESG factors increasingly influence corporate decisions, requiring captives to adapt underwriting and investment strategies accordingly. Option A, incorrect. Insurtech represents an opportunity rather than a challenge, enhancing operational efficiency. Option C, incorrect. While traditional insurance availability fluctuates, it does not significantly impact captives globally. Option D, incorrect. Interest in alternative risk mechanisms remains strong, driven by market volatility. Relevant trends. ESG considerations are shaping the strategic direction of insurance markets globally. Question 10. Captive insurance programs and applications. What is a primary benefit of using a captive insurer to provide employee benefits such as group life insurance? A. Reduced compliance requirements under state and federal law. B. Access to reinsurance markets that are otherwise restricted. C. Increased flexibility in policy design and cost management. D. Exemption from federal regulations such as RISA. Answer: C. Increased flexibility in policy design and cost management. Explanation: Option C, correct. Captives allow for greater customization in employee benefit plans, leading to potential cost savings and efficiency. Option A, incorrect. Compliance requirements may still apply, and captives do not inherently reduce them. Option B, incorrect. Reinsurance access is an indirect benefit and not unique to employee benefit captives. Option D, incorrect. Captives must comply with federal regulations, including RISA, where applicable. Relevant laws. Captive use in employee benefits is governed by federal and state regulations, including RISA provisions. Question 11. Rhode Island captive insurance licensing requirements. Which of the following is a prerequisite for obtaining a captive insurance license in Rhode Island? A. Demonstrating a minimum of $500,000 in initial capital and surplus. B. Filing annual financial statements before receiving the license. C. Submitting a feasibility study approved by a certified actuary. D. Establishing an in-state office for daily operations. Answer: C. Submitting a feasibility study approved by a certified actuary. Explanation: Option C, correct. A feasibility study, often reviewed by a certified actuary, ensures the proposed captive has a viable business plan. Option A, incorrect. While there are minimum capital requirements, $500,000 is not universally mandated in Rhode Island. Option B, incorrect. Financial statements are required post-licensure, not as a prerequisite. Option D, incorrect. An in-state office is not mandatory for obtaining a license. Relevant statutes. Title 27, Chapter 2743 outlines licensing requirements for Rhode Island captives. Question 12. Types of captive insurers. Which type of captive insurance company is most suitable for a single parent company seeking to insure its own risks? A. Group captive. B. Agency captive. C. Pure captive. D. Risk retention group. Answer: C. Pure captive. Explanation: Option C, correct. A pure captive is designed specifically to insure the risks of its parent company and affiliates. Option A, incorrect. Group captives are used by multiple entities to pool risks. Option B, incorrect. Agency captives are often formed by insurance agencies to provide coverage for clients. Option D, incorrect. Risk retention groups typically cover liability risks for members. Relevant concept: pure captives are common for single organizations managing self-insured risks. Question 13. Investment guidelines for captive insurers. Which of the following best describes investment restrictions imposed on Rhode Island captive insurers? A. Captives are prohibited from investing in international markets. B. Investments must be diversified and comply with state prescribed limitations. C. Captives can only invest in fixed income securities. D. Investment restrictions do not apply to Rhode Island captives. Answer: B. Investments must be diversified and comply with state-prescribed limitations. Explanation: Option B, correct. Rhode Island requires captive insurers to diversify their investments and adhere to statutory restrictions to ensure financial stability. Option A, incorrect. International investments may be allowed within limits. Option C, incorrect. Fixed income investments are common but not the sole option. Option D, incorrect. Investment restrictions are in place for regulatory oversight. Question 14, captive insurance and federal regulations. How does the Federal Risk Retention Act impact Rhode Island-based risk retention GS? A. Exempts RIES from state licensing requirements nationwide. B. Allows RIGS to operate in multiple states under a single license. C. Limits RRG operations to the state of domicile. D. Mandates federal oversight of RRG solvency. Answer: B. Allows RIGS to operate in multiple states under a single license. Explanation: Option B, correct. The Risk Retention Act allows ROGS to be licensed in one state and operate nationwide, provided they meet solvency requirements. Option A, incorrect. ROGS must still comply with domicile state licensing. Option C, incorrect. ROGS are not confined to their domicile state. Option D, incorrect. Federal oversight is not directly involved in solvency. Question 15, captive insurance tax treatment. Which of the following describes a tax advantage of forming a captive insurer? A. Premiums paid to captives are always tax exempt. B. Captives can accumulate reserves without immediate taxation. C. Captive profits are not subject to corporate income tax. D. Captive insurers qualify for federal tax refunds on losses. Answer: B. Captives can accumulate reserves without immediate taxation. Explanation: Option B, correct. Captives can set aside reserves for future claims, often with deferred tax obligations. Option A, incorrect. Premiums may be deductible but are not tax exempt. Option C, incorrect. Captive profits are subject to taxation unless specific exemptions apply. Option D, incorrect. Federal refunds do not apply uniquely to captives. Question 16. Regulatory oversight of captive insurers. Which Rhode Island entity is responsible for regulating captive insurance companies? A. Rhode Island Department of Financial Services. B. Rhode Island Insurance Regulatory Authority. C. Rhode Island Department of Business Regulation, DBR. D. Rhode Island Captive Insurance Bureau. Answer: C. Rhode Island Department of Business Regulation, DER. Explanation: Option C, correct. The DBR oversees licensing, financial health, and regulatory compliance of captives. Option A, B, D, incorrect. These entities do not exist or are unrelated to captive insurance regulation. Question 17. Captive insurance formation costs. Which of the following is typically the largest initial cost when forming a captive insurer? A. Actuarial study fees. B. State filing fees. C. Capital and surplus requirements. D. Legal consultation fees. Answer: C. Capital and surplus requirements. Explanation: Option C, correct. Capital and surplus funding represent a significant upfront financial commitment for captives. Option A, B, D, incorrect. While these are notable costs, they are generally smaller than capital requirements. Question 18. Claims management in captive insurance. What is a key benefit of claims management handled directly by a captive insurer? A. Simplified state reporting requirements. B. Greater control over claim settlements and expenses. C. Reduced need for actuarial evaluations. D. Elimination of reinsurance needs. Answer: B. Greater control over claim settlements and expenses. Explanation: Option B, correct. Captives allow companies to tailor claims management to their unique needs, often reducing costs. Option A, incorrect. State reporting remains a requirement. Option C, incorrect. Actuarial evaluations are still essential. Option D, incorrect. Reinsurance needs may still exist. Question 19. Captive insurance exit strategies. Which exit strategy involves closing a captive insurer while transferring its liabilities to another entity? A. Runoff. B. Recapitalization. C. Reinsurance novation. D. Liquidation. Answer: C. Reinsurance novation. Explanation: Option C, correct. Novation transfers liabilities to another insurer, facilitating an orderly exit. Option A, incorrect. Runoff manages liabilities without transferring them. Option B, incorrect. Recapitalization involves financial restructuring, not exit. Option D, incorrect. Liquidation dissolves the entity but does not transfer liabilities. Question 20. Benefits of captive insurance for multinational corporations. What is a primary advantage of using a captive insurer for multinational corporations? A. Avoidance of all local insurance regulations. B. Simplified premium tax calculations across jurisdictions. C. Centralized management of global insurance programs. D. Reduced need for reinsurance agreements. Answer: C. Centralized management of global insurance programs. Explanation: Option C, correct. Captives provide a single platform for managing diverse risks across multiple jurisdictions. Option A. B, D, incorrect. These are either incorrect or secondary advantages not specific to captives. Question 21. Risk control in captive insurance. Which of the following best describes how a captive insurer aids in risk control for its parent company? A. By providing unlimited liability coverage at no cost. B. By incentivizing the parent company to implement better risk management practices. C. By eliminating the need for traditional insurance entirely. D. By reducing the parent company's overall operational expenses automatically. Answer: B. By incentivizing the parent company to implement better risk management practices. Explanation: Option B, correct. Captives often reduce costs for well-managed risks, motivating companies to improve safety and operational standards. Option A, incorrect. Coverage is not unlimited or free. Option C, incorrect. Traditional insurance may still complement captive insurance. Option D, incorrect. Expense reductions depend on effective management. Question 22. Rhode Island Special Purpose Captive Insurance. What is a key characteristic of a Rhode Island Special Purpose Captive Insurer? A. It must provide coverage exclusively for professional liability. B. It is created specifically for securitizing risks. C. It is limited to insuring healthcare-related entities. D. It cannot use reinsurance agreements. Answer: B. It is created specifically for securitizing risks. Explanation: Option B, correct. Special purpose captives are structured to securitize and transfer risk to the capital markets. Option A, C, D, incorrect. These options do not accurately describe the unique purpose of special purpose captives. Question 23. Captive insurance regulatory reporting. What financial document is most critical in a Rhode Island captive insurance company's annual report? A. Risk management plans. B. Statement of actuarial opinion. C. Claims processing logs. D. Underwriting guidelines. Answer B. Statement of actuarial opinion. Explanation: Option B, correct. This document confirms that the reserves set aside by the captive insurer are sufficient to meet future obligations. Option A, C, D, incorrect. While important, these are not the most critical regulatory requirement. Question 24. Reinsurance in captive insurance. How can reinsurance agreements benefit a Rhode Island-based captive insurer? A. By eliminating the need to comply with state financial regulations. B. By providing additional capacity for large claims. C. By reducing the captive's reliance on parent company funding. D. By guaranteeing tax exemptions for the captive. Answer: B. By providing additional capacity for large claims. Explanation: Option B, correct. Reinsurance helps captives manage large or catastrophic losses, enhancing their financial stability. Option A, C, D, incorrect. These are not accurate descriptions of reinsurance benefits. Question 25. Protected cell captive structure. Which statement best describes the key benefit of a protected cell captive (PCC)? A. All cells share liability for each other's losses. B. Each cell operates independently, segregating its assets and liabilities. C. Cells are required to merge after 5 years of operation. D. Only the core company is subject to state regulations. Answer: B. Each cell operates independently, segregating its assets and liabilities. Explanation: Option B, correct. This structure allows multiple entities to share a captive while keeping their operations legally separate. Option A, C, D, incorrect. These statements do not reflect the unique characteristics of a PCC. Question 26. Capitalization requirements for captive insurers. What is the primary purpose of Rhode Island's capitalization requirements for captive insurers? A. To ensure captives can pay dividends to their parent companies. B. To guarantee captives can meet their claims obligations. C. To encourage captives to invest in state-approved funds. D. To reduce the need for reinsurance agreements. Answer B. To guarantee captives can meet their claims obligations. Explanation. Option B. Correct. Capitalization requirements are designed to ensure financial stability and solvency. Option A, C, D. Incorrect. These are not primary objectives of capitalization requirements. Question 27. Taxation of premiums paid to captive insurers. In Rhode Island, what tax treatment applies to premiums paid to captive insurers? A. They are subject to a flat federal excise tax. B. They are tax deductible if the captive operates as a true insurance entity. C. They are automatically exempt from state premium taxes. D. They are considered taxable income for the parent company. Answer B. They are tax deductible if the captive operates as a true insurance entity. Explanation. Option B. Correct. If the captive meets the criteria of an insurance company, premium payments are deductible under federal tax law. Option A, C, D. Incorrect. These do not accurately describe the tax treatment of premiums. Question 28. Captive insurance for employee benefits. What is a potential advantage of using a captive insurer for employee benefits programs? A. Immediate exemption from RSA regulations. B. Greater customization of benefit plans. C. Elimination of third-party administration costs. D. Guaranteed reduction in employee benefit expenses. Answer B. Greater customization of benefit plans. Explanation. Option B. Correct. Captives allow employers to tailor benefit programs to meet specific needs, often with improved cost control. Option A, C, D. Incorrect. These options are not guaranteed or applicable in all situations. Question 29. Captive feasibility study components. Which of the following is typically included in a captive insurance feasibility study? A. A marketing plan for the captive services. B. A detailed analysis of the parent company's claims history. C. A list of potential third-party clients for the captive. D. A regulatory audit of the parent company. Answer B. A detailed analysis of the parent company's claims history. Explanation. Option B. Correct. Claims history analysis helps determine whether forming a captive is financially viable. Option A, C, D. Incorrect. These elements are not core components of a feasibility study. Question 30. Redomestication of captive insurers. What is a common reason for a captive insurer to redomesticate to Rhode Island? A. To gain access to low minimum capital requirements. B. To benefit from favorable tax treatment and reinsurance regulations. C. To expand coverage into international markets. D. To eliminate reporting requirements. Answer B. To benefit from favorable tax treatment and reinsurance regulations. Explanation. Option B. Correct. Rhode Island offers regulatory and tax advantages that attract captives to redomesticate. Option A, C, D. Incorrect. These are not primary drivers for redomestication.